Welcome to another episode of Good Value by Antipodes.
Welcome to another episode of Good Value. Today we're diving into one of the most overlooked parts of global equities, small to mid-cap companies, or SMIDs. SMIDs are one of the broadest and most diverse investment universes, and they're currently priced at their biggest discount relative to large caps in 20 years. So now's a great time to explore the asset class, a universe full of innovation, under-researched businesses, and mispriced opportunities. But it's also a more volatile asset class, which makes research depth and portfolio construction particularly important. Joining me today is James Rodda, Portfolio Manager of the Antipodes Global SMID Active ETF. The fund celebrated its 3-year anniversary in November, has been the best performing strategy in its peer group since inception, according to Zenith and Morningstar, and was recently announced as the winner in the International Equities Global Small Caps category at the 2025 Zenith Fund Awards. And for those who may not know, the fund is now available on the ASX under the ticker MIDS, M-I-D-S. James and I are going to unpack why global SMIDs deserve more attention, how Antipodes approaches this space differently, and talk through 2 opportunities that are capturing our interest right now. And if you can believe it, they are not part of the AI story. James, welcome back to the podcast.
Thanks for having me again, Alison.
James, can you set the scene for global small to mid-cap stocks? How does this part of the market differ from large caps in terms of both behaviour and opportunity?
Yeah, look, I think it differs in quite a few different ways. So in terms of opportunity, if we start with valuation, there's a large dispersion, a record dispersion between large cap global stocks and small to mid cap global stocks. So large caps now, that top 25, 30% that we focus on and think about when we look at large caps, not just the mega cap tech, but, your Walmarts and your Costco's. As a group, trade at 33 to 34 times earnings, while SMIDs are 18 to 19 times. So SMIDs would need to rise by approximately 70% to trade at the same multiples as large caps. This is the largest discount in a long time, in over 20 years, and very different to the long-term premium that they usually trade up versus large caps. So why the discount? I think the first thing to recognize is the 2 cohorts, despite that valuation spread, are growing at a very similar rate. So you're paying around twice the multiple for large caps without getting meaningfully higher growth in return. In fact, the return growth on a 10-year view has been less than 2% per annum in terms of sales growth. Most of the change in actual stock return has been re-rating of that large cap groups. In terms of when we think relative to their own history, large caps are priced at 20-year high multiples, and SMIDs are in line with their long-term average valuations. So SMIDs are not only attractively priced relative to large caps, they're actually attractively priced relative to their own history. And that's unusual, be it large cap global stocks or large cap Australian stocks. So we think it's, the valuation case is strong for owning global SMIDs in client portfolios. In terms of other reasons, apart from growth, index investing, ETF-based index investing, is clearly another one where you have significant flows flowing into particularly the S&P 500 and NASDAQ ETFs, where we know that the buying is not focused on the multiple that they're paying or the intrinsic value of the company that they're buying. In terms of, how to tackle the asset class, I think active management, is really suited here overall. We have 7,000 stocks in the benchmark. The top 10%, top 10 names are sort of 2% of the index. And they're typically names that will actually move out of the index on a reweighting. There's 50,000 stocks listed globally. So in SMIDs, if you have a great idea or you notice some change from your industry research that we go through, you can always find a way to express it. That compares to large cap index, where 2,500 stocks, but the top 10 are around a quarter of that index globally. So in SMIDs, we have a much bigger, more diverse opportunity set that we can pinpoint precise ways that we want to play some form of change. We can always find a way to do that. In terms of coverage, I think that's another interesting difference. So once we go to the small cap end of SMID, around 80% of those companies are not covered or barely covered by sell-side analysts. And so that means there's more opportunities for market inefficiency. Even more than that, and I can't give you a statistic on this, but I can get 100 pages of industry research from brokers on the electric vehicle industry, the AI industry, drug pricing industry, or drug pricing within pharma. But I can't get industry research on smaller companies or niches within larger industries. You have to do that work yourself, and that Antipodes focus with our 30-person team, really plays to our strengths because we focus on that industry research. And in small caps, we know that stocks are more volatile, and that greater volatility can be your friend on one side, obviously, if you get things right, and it can hurt you if you get things wrong. So what we want to do is buy a company, but be really aware of what's going on around it. And that industry research coverage just doesn't exist. So we need to do it ourselves. And that 30-person team, I think, is well placed versus a 3 or a 5-person stock picking team to find those better opportunities in the small and big cap space. In terms of active management, the other thing is, on that volatility, small caps and mid caps are more volatile than large caps. So think of this as Mr. Market giving you more opportunities more regularly, be it to sell something that may have moved up quickly, or likewise buy something that's moved down more quickly. Great opportunities for active management, more regular mispricing. And so the other thing with that volatility, I would say, is, diversification smooths it out. So we're running a 70 stock portfolio that is in that range at all times, sort of 60 to 70 stocks. And so it is more diversified to handle that volatility. And we're also invested across all 11 gig sectors. We're not concentrating on best ideas in terms of sectors. We're finding the best ideas within each sector, really believing that change happens everywhere, looking to exploit that for our investors.
So, James, calling out a few of the points you just made, so you've said SMIDs are cheaper and they're under research relative to large caps. So that's very fertile hunting ground for finding opportunities. But as you've said, also more volatile. How do you think about managing that risk while still being able to capture the opportunity? You did say diversification. Is there anything else you'd call out there?
Look, I think I just point out the criticality of the diversification. So that 60 to 70 stock range is a significant number in terms of spreading portfolio risk across names. It's a level of genuine diversification. But obviously, in the context of an index with 7,000 stocks, we're still, targeting what we think are the best ideas. To broaden that out, I would say we're globally diversified. Think about having stock holdings in 20 different countries. Around 40% of the portfolio at the moment is in the US and North America. We find great opportunities there. But the rest of the portfolio, we also find great opportunities in Europe and emerging markets. So that diversification is, stock count is important, geography is important, and also industry sector. In terms of thinking about what it's meant for us, if we break down the alpha that we've had in the fund since inception, so in excess of 13% per annum, the vast majority, circa 90% of that is stock selection. So that's in each of the 11 gig sectors, picking stocks that outperform their sector. A minority, around 10%, is actually allocation. So picking which sectors will do better. Obviously, at given points in time, the market can get really positive on, AI stocks at the moment. And you want to do well when AI is doing well, but you also want to do well when that reverses. And we've seen that recently in terms of healthcare, which has been a laggard sector that we'd maintained consistent exposure to. And the market for that has turned in the last month or so. We've had several positions in the portfolio that have allowed continued strong performance, as you've seen a bit of a reversal in what the market is rewarding.
I think that's a really good point, because often when we do talk about diversification in portfolios, we do often just think about number of stocks, having a portfolio that is, as you said, has more than 20 to 25 names. But I think what you've pointed out, which is, maybe a less obvious point is that diversification isn't just your stock count. It is being broadly diversified across regions and sectors, and all of that gives you that, the ability to, or the protection against some volatility. Now, SMIDs, as we've established, very attractively priced today. But the macro backdrop does still feel uncertain. We've got slower growth, geopolitical tensions, tariffs, inflation. How do you think SMIDs are positioned in an environment that does feel uncertain on many fronts?
I think they're well positioned. I'd go back to that valuation point as being, really interesting from the starting point. So people talk about perhaps, I don't think we're there at all, but maybe heading in that direction. A real boom in markets, the tech bubble in 2000, and in the 18 months following, the Nasdaq was down 70%, and small cap value was up 25%. So you had 30 cents in one and $1.25 in the other. So I think starting multiples matter, and stock selection matters, regardless of those macro points or market direction. In terms of what's happening now, I think soft US dollar, which it's broadly been this year, is usually good for ex-US markets, good for Asia. Inflation's trended down and more neutralized. At the same time, potential for interest rate cuts, which are generally good for all companies, but small mid-cap companies often typically benefit more in their stock performance. When we look around, the environment in some areas is changed to AI, maybe more difficult for smaller companies in general to adopt systems and technology. So we're aware of the tech stack and the companies we invest in, regardless of the sector or the industry. But overall, valuations, I think, are a degree of protection. Growth rates in the asset class are in line with large cap growth rates at obviously that lower valuation. And the process you follow as an investor makes a big difference. So the fund has a down market capture ratio of 46% since inception. This means that in the months where the market's fallen, we've on average fallen 46% of the market fall, which is pretty good for a long-only fund. And it's obviously consistent with all the Antipodes, the two other Antipodes Global funds. And it really is an output of the risk-first process that we have to investment.
And I think that's a really good segue into the way Antipodes approaches this part of the market. So, James, to reiterate your point, I think process does really matter in SMIDs. And you called this out in some of the earlier questions. But Antipodes starts that research process at the industry level rather than with the individual stocks. So going broad before going deep. And the focus is to understand the change that's taking place in the industry, whether that is cyclical, structural, or socio-macro change, and positioning for mispriced change. James, why do you think this approach is particularly powerful in the SMID cap space?
Yeah, so look, I'd say our research process begins with that slow thinking, detailed industry analysis. So this gives us a deep understanding of industry leaders, what they are doing, what their customers are doing, in the competitive environment. And once we understand that and how value is created, where disruption is occurring, it gives us a much better sense of how a structural change story or an industry cycle will play out. Linking that back to SMID, that gives us more confidence in these SMID, smaller mid-cap stocks around which names have genuine competitive advantage. So we want to buy the winners and avoid the losers. Then, put it through the valuation test to find the ones that are underappreciated and have large upside. And hopefully when we do that, having that raw, detailed industry analysis means we get less things wrong. And getting, the extra volatility in this space, the large number of stocks, hopefully you always have your big winners. Getting less things wrong really improves returns significantly. And of course, if you're not wrong, you're much more likely to be right. And so that industry research increases the chance that we're right. So, it's a 30-person investment team, very well resourced with the capability to do this deep analysis that often on these smaller sectors or upstream or downstream sectors, many cannot spend the time to do that properly. We spend that time, we understand the industry, we identify opportunities, up and down the value chain. So I think that team is a strategic advantage. It's not just me as one PM supported by a few analysts doing bottom-up work. Yeah, we do the bottom-up work, but it's aware of the industry dynamics. And I'm supported by that large team and investment platform, and taking it to examples where it matters. I think if you're buying a retailer and you're not following what Walmart and Amazon are doing, they dominate the retail landscape in terms of their market share and their incremental market share in the US. You're really taking a big risk that you miss something and you make a mistake. Or in software, if you're not watching Microsoft or Salesforce or these large companies, again, these are typically the names that can often displace or disrupt your product or service by turning what you have built, your software product, into a feature within their larger bundles. So we spend a lot of time on what the larger companies are doing. That allows us to isolate change in smaller companies, where they're less likely to run into competitive concerns from those mega companies. When we do that change, I'd probably say the other thing is, we're really disciplined about making sure it's mispriced. All sectors, all regions to find these opportunities and zero in on underappreciated stories. So an interesting example would be in real estate. Perhaps they're the most interesting change opportunity, many would say, is data centers. But we think this is well understood by the market and certainly, firmly priced. Whereas also in real estate, we think senior living, so think facilities that people spend the last 2.5 years of their life in. We think that sector is also a great change story. The baby boomers turn 80 next year. We think that's an underappreciated change story where we can have high expected returns. There'll be shortages of bed, occupancy will increase, pricing will increase, profitability will grow. And so our largest position in the fund is Brookdale, a senior living provider. We think we can triple our money in that real estate opportunity and really benefit from change that's underappreciated rather than just investing in change where, it's appreciated and perhaps the return to us as investors may not be as high to the upside. It may also have more downside, less asymmetry. So we're focused on change, and the expected return or the margin of safety.
And I think that focus on understanding the industry backdrop really does show up in the fund's upside-downside capture as well as in performance. And I know you called out some of these numbers earlier, but over the last 3 years, the Antipodes Global SMID Fund has captured 130% of the market upside while participating in only 57% of the downside. And those numbers are all net of fees. And look, strong numbers for a long-only strategy. And I think that, when I think about those numbers, that it shows that the process is picking those genuine winners and avoiding those companies that are most vulnerable to disruption. And the returns, you called this out at the top of the podcast, but, 27.4% per annum since inception, again, net of fees, almost twice the index. Let's spend a little bit more time unpacking that performance. What have been the key drivers behind it?
It's been very broad. So we've had, stock selection alpha in 10 out of 11 GIC sectors, which is pleasing. And as mentioned, most of that alpha, the vast majority, has come from stock selection rather than over or under allocating to any given sector. So the performance has been very, very broad. Yes, we have picked better than the opportunity set in technology, but we've also had stock selection alpha, large alpha in stock selection in financials, in telcos, in mining companies, in industrials, in real estate and healthcare and so on. So I think that's been a big driver of the returns, is kind of the selection broadly rather than I'd highlight one individual driver. Something else I mentioned at the start, active management. So again, just being able to be disciplined with our expected returns and using that volatility to advantage. And so when things are bang up, we will take some profit, particularly when they're up for no good reason and our target price hasn't changed. We'll look to take that profit and and will also look to increase positions as they sell off for no good reason. And we find that this happens, significantly more in this space. And so I think that's just that behavioral side is really important here, and I think we do that well.
James, you've set the scene for us. Now let's bring this to life with some real examples from the portfolio. What's one interesting change opportunity you're seeing in the market right now that really illustrates the research process and the type of ideas in the SMID fund?
Yeah, sure. I think I'll talk about, the energy sector. Over the last 15 years, US shale production, so this is onshore oil production from the US, has accounted for the vast majority of incremental oil barrel production globally. If we think back to when oil was above $100 a barrel in the early 2010s or 150 a few years before that, OPEC ruled the oil markets, and shale didn't exist. We had a peak oil narrative where the general consensus in the late 2000s was that we were going to run out of oil. So what happened was the incremental barrel was seen to be deep water offshore. So we had a huge ordering cycle in terms of equipment for deep water offshore oil. And that meant that by the early 2010s, just as shale came through, we had a lot of equipment, particularly offshore rigs, that had been ordered and didn't have any demand. Since that point in time, with the growth of shale, a lot of those rigs never got used and they've continued to be scrapped. At the same time, we think the shale story is, mature or coming to the end, and all the tier one acreage in the shale basins has been depleted. And what we would expect out of the US, despite Donald Trump's desires, is oil production overall to flatten or potentially dip, over the next decade. In that world, we think that you resume to that peak oil narrative where the incremental barrel of oil is found deep water offshore. The fixed cost per barrel for deep water offshore has also come down with improved seismic technologies and targeting and drilling, et cetera, such that around 85% of discoveries that we find now are economic at below $60 a barrel. A good example of that's Exxon, which discovered Guyana and is now taking it to well over 1 million barrels of oil per day using 5 drill ships in constant rotation. We've been in a down cycle in offshore. We see the catalyst for change being shale peaking and a desire for the large oil companies to continue to grow reserves, or at a minimum replace reserves, and offshore is kind of the place to do it. In terms of how we take that change story at the industry and we look for an investment, the interesting thing for us is that a lot of these rigs that were ordered before the shale revolution and delivered into that revolution have been scrapped. And we're now at the point where offshore drill rig utilization is around 80%. We think it'll be 90% by next year, by the end of 2026, and then can hit 100% sometime 2027, 2028. We own a stock, the largest position we own, targeting this change is a company called Valaris. Valaris owns, modern drill rigs, and we're paying for them about $250 million a rig in the stock. That's really attractive because to buy a new one today would probably cost you $1 billion. So about 4 times what we're paying for it at the company level. We have a market where they're already profitable, making nice cash flow, and a catalyst to make significant cash flow in the next few years. So you think about our prediction for 100% utilization, maybe 2028, 2027, to order any new rigs at $1 billion, you're going to probably need to make a 25% return, let's say $250 million per annum in profit. And you're not going to want to just make that for 1 year and have the confidence to order. You're going to want a contract for that allows you to make that profit for 5 years, and then you may go and spend $1 billion on a new one. And then you have to wait another 3 years, 5 years for it to be delivered. So we see potentially, an industry with very long profit cycles in terms of the upside and the downside, just inflecting to become profitable. We're entering the stocks at what we believe can be a single year of profit at some point over the next few years. We've met management teams across the sector. Valaris, the largest position we know that we own, we believe the CEO will use all that capital to buy back stocks. So, we think that in a few years we may be dealing with a share price that is much higher, not just because of the earnings, but also because I have a lot less shares on issue.
What I really like about that example, James, is that, through this research process, the industry research process that is, you and the team have identified a very specific part of the value chain in the energy complex that you want exposure to. And I guess what's great about the SMID cap space is you can get very specific exposure to the change that you want to target. And that arguably, I guess, is harder through large caps. Yes, you can get this exposure in the large caps, but I guess it would be a much smaller part of their business. So what am I trying to say? Through the SMID caps, you can be very specific and get the direct exposure that you want. Is that a fair sort of summary?
Yeah, I think in this case, there's many large caps with offshore exposure, but they now also have a lot of onshore exposure and gas exposure, which is not necessarily a bad thing, but it's not the most exciting thing that we think and we see in that change story. And yeah, with the smaller name, we're able to find, more pure plays to express, what we think is interesting.
Okay, let's finish with a podcast favorite. I'm going to put you on the spot. What's the one investment in the portfolio right now that you think has the most compelling combination of underappreciated opportunity around change and valuation?
Sure. I think I'll go with IWG. IWG International Workplace Group is the global leader in flexible office space. So it has 4,400 centres in 120 countries. It's by far the largest player in the industry. WeWork, under its new ownership, is the number 2, and it's about 6 times larger than WeWork. And so this is a great story around multiple industry changes presenting an opportunity. The pre-COVID versus post-COVID industry structure, flexible office sector has changed. And we think that'll really benefit the incumbent IWG. So first of all, there's a shift to hybrid working and work from home that happened due to COVID. And so because of this, traditional office occupancy has been permanently reduced. This has weakened landlords' pricing power and led to increased demand for flexible solutions from corporates. At the same time, in the lead up to COVID, we had a decade-long cycle of venture-funded hypergrowth. And this is most famously exhibited in WeWork, which at its peak in 2019 was the largest landlord of office space in New York. As we know, they were selling $1 for 80 cents and had an unsustainable business model. Competing against unsustainable business models is difficult, and IWG had to do that. But this has now come to an end, and they've now got rational management, owning that company. But capital has left the sector, and the barriers to scaling a global co-working business have also risen sharply. So whilst it's easy for a small operator to open 1 or 2 locations, it's extremely difficult to build a large multi-city, multi-country network without deep capital market support. And we know through many large contracts with large enterprises that global access when people move around the world is, really a large competitive advantage. The dynamics here put IWG in a strong position as the industry rationalizes following the bankruptcies of, WeWork and other players who've come back, typically with more rational ownership, but often just exited the sector altogether. So the number of US co-working locations fell in, the second quarter of 2025 when we look at the industry numbers. So our view is the winning model favors operators with these global networks, the hub and spoke footprints that appeal to large corporates. It's unlikely that any competitor can ever replicate IWG's breadth of locations and create a genuine global competitor. So this network is a moat for IWG. It has a multi-brand approach, which allows it to serve a wide range of pricing points, and we just think it's really well priced. Now, the other interesting thing with the move to co-working and flexible office space in terms of demand is work from home has meant there's more office supply that is vacant. And so if we think about the business model as it led up in the lead up to COVID, you would go to a landlord, pay to fit out a couple of floors, and then lease it out for co-working. And the business model wasn't that great. So over the past 20 years, IWG's generated roughly what it spent in capex in EBITDA from its own centres. So it's spent about $6 billion, about $6 billion in EBITDA that it's earned in return. And so obviously that's not very interesting, but the change is interesting. So following COVID, landlords have more vacant space. Obviously, if you're a landlord, you typically have a significant loan against your office. And so your utilization or your rental income is levered. And the difference between being 60% full versus 70%, or it might be 80 versus 90, is significant in terms of the equity value. And so IWG has shifted to a capital light model. It now has more than 1,500 centres on a managed and partnership model with a similar amount in the pipeline. And we think these centres will be as big as their company-owned centres by the end of the decade. The business model here is, think about Marriott or Hilton. So Marriott and Hilton go to a hotel owner, offer their brand, offer to fit out the hotel, and if they want, hire all the staff to cover the front desk and do the cleaning and manage that whole process. That's what IWG is doing for these landlords under the new model, and they're taking a similar fee to what a Marriott would take for that full service experience in the order of 15% of the co-working revenue. But critically, whilst IWG is fitting out the offices, they then send the invoice to the office owner. And the office owner is happy to have return of capital on that capex because they also get the base rent. And that base rent in a leverage business model, being an office owner, creates significant value for their equity in the offices. And so this is a radical shift in the business model that we see. A lot of the sites aren't yet mature, but we're watching the cohorts closely, and they're maturing, very well. And we think, a majority of the incremental gross profit before the end of the decade is going to come from this managed and franchise segment at very high incremental profit because there is really no capital invested. So we think as these places, just what's contracted in the existing base, when we model what matures and comes through, we're going to be left with a company in 2028 trading on, around 6 times earnings, high teens free cash flow yield that potentially still has a growth rate of 20% a year or more in 2029 and 2030. That type of stock could trade on in excess of 20 times earnings. Certainly the Marriotts and the Hiltons do with significantly lower growth rates. So I think it's a compelling opportunity on that 6 times earnings, about 2028 estimates. And we think we can, multiply our money many times over if they simply execute on the contracts that they have already with landlords for shared workspaces under this business model.
Yeah, that does sound like an incredibly attractive valuation relative to that growth profile. James, that's all we have time for. Thank you for those broad insights and stock stories. It's always great to have you on the podcast.
Thanks, Alison.
And for listeners who want to learn more about the Antipodes Global SMID Active ETF, visit antipodes.com.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.